In 2000, two finance professors named Brad Barber and Terence Odean pulled the records of 66,465 real household brokerage accounts and tracked every trade they made from 1991 to 1996. The traders who traded the most earned about 11.4% a year. The market over that same stretch returned about 17.9%. Same market, same stocks, same information available to everyone. The only difference was how often they hit the button. That gap wasn't bad luck or bad picks. Their gross returns before costs were almost identical to everyone else's. They just traded themselves out of 6.5 percentage points a year. Here's what makes that study impossible to shrug off. It wasn't a small sample. It wasn't a single wild year, and it's been replicated across different markets and different decades since. The more retail traders trade, the worse they tend to do. And most of them have no idea it's happening because each individual trade feels justified in the moment. So the question this video answers isn't should you trade less? You've heard that. The question is why you can't seem to stop. Today we're talking about overtrading and the real reason it happens. We're going to break down what overtrading actually is, the psychology that drives it, what it looks like on your chart in real time, and the specific difference between how a retail trader and a professional handle a slow session. Not financial advice, just education. Let's get into it. So let's start with what overtrading really is, because most people define it wrong. They think overtrading means taking too many trades, like it's a number problem. It isn't. Overtrading is taking trades that don't meet your own criteria. You can take 12 trades in a day and not be overtrading if all 12 fit your plan. You can take 2 trades in a day and be overtrading if neither one belonged. The number is a symptom. The real issue is that you're pulling the trigger on setups your own rules would reject, and you're doing it because sitting still feels worse than being wrong. That's the mechanism underneath all of it. Overtrading isn't a strategy failure, it's an emotional regulation failure wearing a strategy costume. Think about a dam. A dam's entire job is to hold back water and release it in controlled amounts only when it's supposed to. An overtrader is a dam with a crack in it. The pressure builds up, boredom, the itch to make back a loss, the feeling that you're missing something, and instead of releasing on schedule, it leaks. Every leak is a trade that shouldn't have happened. And here's the cruel part. The leak relieves the pressure so it feels good for a second. That's why it's so hard to stop. The bad habit pays you emotionally right before it costs you financially. Retail traders think their problem is that they need a better setup. Professionals know the problem is that they need to not take the setup they already know is bad. That's the whole game. The edge was never just in finding good trades, it was in refusing the mediocre ones. So where does the pressure actually come from? Let me give you the 3 engines, because if you can name what's driving you in the moment, you can catch it. The first is boredom, and it's more dangerous than fear. Good trading is mostly waiting. The market gives you a genuinely clean setup a few times a week, not a few times an hour, and the hours in between are quiet. Your brain is not built to sit in that quiet. It's built to do something. So you start seeing setups that aren't there because your mind would rather manufacture a reason to act than tolerate doing nothing. You're not analyzing the chart anymore. You're negotiating with it. The second engine is revenge. You take a loss, and now there's a number on the screen that feels like a debt and you want it back immediately. This is where the size creeps up, where the plan goes out the window, where you take the trade you'd normally skip because a normal trade won't undo the loss fast enough. Retail traders try to win the money back from the market. The market doesn't know you lost anything and it doesn't owe you a refund. The third engine is the phantom, the fear of missing out. A move takes off without you and the regret of watching it go is sharp enough that you chase the next thing that even slightly resembles it just to not feel left out again. You're no longer trading the setup, you're trading the memory of the one you missed. Let me walk you through what this looks like in practice. It's a Tuesday. The market's been ranging in a tight box all morning. No clean structure, nothing that fits your plan. Around 11 a.m., you're bored. Price pokes above the top of the range for a single candle and you feel it, that little pull, and you tell yourself, breakout. You take it. It immediately falls back into the range because it wasn't a breakout. It was noise and you're down. Now you're annoyed. 20 minutes later, you take a second trade, bigger to get the first one back, and it's an even worse setup than the first. That one loses too. By noon, you've turned a quiet nothing session, a session where the correct move was to make 0 trades, into 2 losses and a bad mood. Nothing on that chart forced you to do that. You did it to relieve the pressure of doing nothing. Here's the split. On that same Tuesday, the retail trader sees the range as a problem to solve, an obstacle between them and the action they came for. The professional sees the exact same range as information. The market is telling me there's nothing here, and my job is to believe it. Retail asks, how do I find a trade in this? The professional asks, is there actually a trade here, yes or no? And when the answer is no, that's a complete answer. Doing nothing is a position. It's the position of not handing your money to a market that isn't offering you anything. The lesson underneath all this is that a flat day defended is a win, even though it never feels like one. The account you don't damage on a bad day is the account that's still there for the good one. So how do you actually stop? This is where I have to be honest with you, because I'm not going to pretend there's a trick that deletes the urge. There isn't. The urge to overtrade doesn't go away when you get better. It just gets quieter and you get faster at recognizing it. What changes is that you learn to feel the pressure building and name it before it becomes a trade. That's boredom. That's revenge. That's the phantom. Naming it breaks the spell because the whole thing runs on you not noticing it's happening. A few honest warnings, because this is the part most channels skip. First, understand that fewer trades will not automatically make you profitable. Trading less is necessary, but it's not sufficient. If your actual setups are bad, doing fewer of them just loses you money slower. This is about removing the trades that were never good, not about worshipping patience for its own sake. Second, use a stop on every single trade, including and especially the revenge trade you swore you weren't going to take, because the trades you take in a compromised state are exactly the ones most likely to run against you hard. Third, don't over-engineer the solution. Some traders react to overtrading by adding 15 new rules and 8 indicators, and now the chart is so crowded they can justify anything, which is the same disease with more steps. Keep your criteria simple enough that does this fit or not has an obvious answer. And fourth, and this is the one that matters most, on a genuinely bad day when nothing is working and you're rattled, the correct action is to do nothing. Close the platform. There is no rule anywhere that says you have to trade today. The market is open tomorrow and the day after and for the rest of your life. Here's the shift I want to leave you with. Stop thinking about overtrading as a chart pattern. You need to identify and start seeing it as a decision you keep making. There's no overtrading candle. There's no overtrading indicator. Every single one of those unnecessary trades was a choice made by a person under pressure to relieve a feeling instead of follow a plan, which means the fix isn't out there on the chart. It's in the half second between the urge and the click, and that half second is completely yours. The professional isn't someone with more discipline handed to them at birth. They're just someone who learned to live inside that half second. So here's my question for the comments, and I actually want you to answer this one honestly. Which of the 3 engines gets you the most? Boredom, revenge, or the fear of missing out? Be specific about the last time it happened. I read these, and naming it out loud where other people can see it makes it real. If this helped you see your own trading a little more clearly, go ahead and subscribe, because that's how the channel grows and it's all I ask. I'll see you in the next one. Stay disciplined.